Hey folks, I'm best-selling author of The Power Zero, David McKnight. In today's video, you'll see part one of my interview with podcast host Jesse Wright, in which we discuss why your effective tax rate could double by 2030 and why now is the best time to build a plan that helps shield your hard-earned retirement savings against those higher taxes.
Welcome back to another episode of Our Podcast. Today's guest is David McKnight, the best-selling author of the book, The Power of Zero, How to Get to the 0% Tax Bracket and Transform Your Retirement, which has also been made into a full-length documentary film. David is also the author of the book, Tax-Free Income for Life, a step-by-step plan for a secure retirement. Thank you so much, David McKnight, for joining us today.
My pleasure. Thanks for having me.
Over the last maybe 3 or 4 months, I've read at least 30 books on retirement planning. And I would say after reading these at least 30 books, I'm more confused now than I was before I even started reading these books. And I'm not even sure where to begin. You can talk about Social Security. When should you start drawing on it? You have your 401ks, your IRAs, Roth IRAs. You have Roth conversions, Medicare. Should you have Medicare A, B, or D, or Medigap? Just even that's a whole topic on itself. Then if you have income coming in and you're over the age of 65, then you have to worry about Social Security provisional income. I would say I'm even more confused right now than I was before I picked up a single book. As an expert in this, where do you even start when you start talking about retirement?
Well, I mean, it sort of depends on where you are in your retirement journey. If you're sort of in your accumulation years, you've got to start with, number one, are you diversified? Are you saving a portion of your paycheck at the beginning of the month and then spending whatever's left over, as opposed to spending whatever you have and hoping and praying that there's money left over at the end of the month? And just understanding what a good long-term investment objective is. Are you timing the market, or you just prefer to have time in the market as a strategy? I'm the type of guy that says, put your money in the market, make sure it's rebalanced on a consistent basis. Take a nap for 30 years, you wake up a millionaire. So if you're rapidly approaching retirement, then there's some different strategies you want to use. But generally, the theme that I try to communicate to the country is simply that the types of accounts within which you save money for retirement really matter. There's essentially 2 ways to save money for retirement. You can get a tax deduction today, or you can pay the tax today, invest your money, so that at some point down the road, when tax rates, I believe, are likely to be dramatically higher than they are today, you've done all the heavy lifting, you've paid the IRS, you can then take that money out tax-free. So really, I wrote the book, The Power of Zero, back in 2014, because I sort of saw the handwriting on the wall. I saw that the country was spending far more than what it was actually bringing in by way of tax revenue, and that those long-term trends were only going to get worse over time, and that even the Congressional Budget Office was predicting that the national debt was going to grow by $2 trillion per year by 2033 and by $3 trillion per year every year thereafter. It's just going to get worse and worse and worse. So I'm starting to ask myself, hey, if you have money in your 401k or IRA and you haven't paid taxes on those retirement savings yet, and tax rates way down the road when you're planning on taking those dollars out are likely to be dramatically higher than they are today, then how much of your hard-earned retirement savings are you really going to be able to keep? And so it just felt like, if you think about 95% of the cumulative retirement savings of Americans all across the country are in these types of tax-deferred retirement accounts like 401ks and IRAs. In other words, they've postponed the payment of those taxes to a point in the future beyond 2030, when I believe that tax rates have to be much higher just to pay our bills as a country. And so I wanted to raise a warning cry to this entire generation of baby boomers and pre-baby boomers, Generation Xers, that are getting these deductions and doing so at historically low tax rates, only to postpone the payment of these taxes until a point in the future when tax rates are likely to be much higher than they are today. So Power Zero turns convention on its ear. It says, hey, we're no longer in the 70s where marginal tax rates are 70%. We're in the midst of what I call the tax sale of a lifetime, which means with the Trump tax cuts in 2018 that are set to expire in 2026, we're experiencing among the lowest tax rates we've seen in our lifetime. So why are people continuing to get deductions at these historically low tax rates when tax rates down the road are likely to be, some cases, some experts are predicting, double what they are today? And so really the Power Zero was an effort to get the word out to a retiring generation of baby boomers that, hey, maybe we need to turn convention on its ear and start doing things a little bit differently when it comes to wringing the most efficiency out of our retirement savings.
Yeah, I thought your book did a good job of kind of showing the semantics of these accounts that are tax deferred. It's really just tax postponed.
Right. Yeah. So that's, yeah, you're going to pay the tax. The question becomes, is your tax rate likely to be higher today in the case of making a Roth IRA contribution? Or is it likely to be higher down the road in the case of a traditional IRA contribution when you're postponing that payment till a point, maybe 20 years down the road? And so I'm just hoping to educate people on the fiscal condition of our country, because tax rates over time, a lot of people don't realize that tax rates in 1946 were 94%. That doesn't mean that you're losing 94% of your income. It meant that any dollar you earned above and beyond $200,000, you only kept 6 cents on the dollar. I'm not saying tax rates are going up to 94% again. I am saying that all of the experts that I've interviewed have suggested that we need massive infusions of cash in the very near future. Some experts, a guy named David Walker, former Comptroller General of the federal government, even wrote a CNN op-ed that said tax rates have to double. In his book, Come Back America, he said that tax rates have to double by 2030. And we're not talking like just a doubling on the margin. We're talking a doubling of your effective tax rate. That means that most Americans who are now paying, 20% of their income between federal, state, and local taxes, that's going to go up to 40% or more by 2030, according to David Walker, who I think is the guy that knows more about these numbers than just about anyone else on the planet. So it's scary stuff, but we've been sort of lulled. We've had sort of low taxes for so long now that people forget that tax rates in the past were much higher than they are today, and that they have the ability to return to those higher rates whenever the government needs huge infusions of cash. And I sort of like to tell people, when you put money into your 401k, it's like going into a business partnership with the IRS, and every year they get to vote on what percentage of your profits they get to keep. It's not a very good business partnership, if you ask me. So you could have $1 million in your IRA, but unless you can accurately predict what tax rates are going to be in the year you take that money out, you don't really know how much money you have. And it's pretty hard to plan for retirement if you don't know how much money you have.
I was just amazed by just the complexities of everything. For instance, if you take money out of your 401k when you're over the age of 65, and then that could be considered provisional. Is it provisional income, right?
Provisional income, right?
Provisional, yeah, sorry. Because apparently I can't pronounce words, but provisional income. So that money, first they tax the money you're pulling out of your 401k, and then if you pull out enough, 85% of your basically 85% of your Social Security would then be taxed. So having a strategy, not only would you save money on the tax in that initial account, but then on your Social Security.
Yeah, so this is a huge point that most people never even think about or even realize, that when you take money out of your 401k or IRA, or you get 1099s out of your taxable investments, and you, like say a brokerage account, that all that counts as what you rightly referred to as provisional income, which is the income the IRS tracks to determine if they're going to tax your Social Security. So if you're single and that provisional income adds up to more than $34,000, or if you're married and it adds up to more than $44,000, then like you said, up to, it's not like you hit that $44,000 threshold, it's automatically 85, sort of a sliding scale, but up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. And I like to give sort of a math comparison. I say, hey, look, let's say because of all your distributions from your 401k or IRA, you got to pay a $5,000 tax on your Social Security. In other words, you got a $5,000 hole in your Social Security. How do most Americans go about plugging that hole? Well, by taking more money out of their IRAs and 401k. So let's say that what David Walker says comes true, and tax rates go up to 50% to keep our country solvent, pay for Social Security, Medicare, Medicaid. How much money would you have to take out of your IRA to be able to pay that 50% tax to the IRS and then be left over with $5,000 with which you can then plug the hole in your Social Security? Well, the answer is $10,000. So you have to take out $10,000, you pay $5,000 to the IRS, so you're now left over with $5,000. You use that to compensate for that hole that is now in your Social Security because of Social Security taxation. I've done the math on this lots of different times. And the sad truth is that you run out of money 5 to 7 years faster when you have to compensate for Social Security taxation than people who do not have to compensate for Social Security taxation because they grew their money in tax-free accounts that do not count as provisional income when you're drawing your Social Security.
What age do you really have to start focusing on this? And everyone's like as young as possible, which of course it's like, well, no shit, Sherlock. But for people that maybe, you go to college, travel or whatever, you got some low-paying job. It's not like when you're 25, you're thinking about your retirement. It's so far off. So I feel like maybe people, when they hit their mid-30s or 40s, that's when they are like, oh shit, I'm going to retire in 20 years, or I hope to. So what age should you really be buckling down? And then how does that change your strategy, if at all?
So a couple of thoughts. Obviously, when you have time value of money on your side, you have compound interest on your side. The earlier you can start, the better. Back in the day when I used to educate younger people on this type of stuff, I would tell the story of two twins. One saved $8,000 a year for 8 years and then never saved again. And the other twin didn't save anything for 8 years, started in the 9th year, and then saved money for the next 30 years. And I always ask my clients which one had more money at the end. And they always say, oh, the guy that started in the ninth year, because he saved much more money over time. Well, the reality is the twin that started saving those first 8 years ended up having much more money than the other person, even though he saved much less because he had the power of compound interest and time on his side. So when it comes to the world of investing, now is always the best time to get started. And when it comes to which types of accounts you should be investing in, I always tell people, hey, the farther out your investment horizon, the farther out your retirement date, the more critical it is for you to invest in tax-free accounts like Roth IRAs, Roth 401ks, Roth conversions, things like that. And the reason that is because if you look at the debt curve of our nation over the next 75 years, it literally goes from adding $2 trillion per year of debt. And about every 10 years, you can add another $1 trillion to that. So $2 trillion per year, and then $3 trillion per year, $4 trillion per year. It literally just grows and compounds and just turns into this massive train wreck over time. And so I tell younger people, the farther out your retirement horizon, the more likely tax rates for you are likely to be dramatically higher than they are today. And I'm telling people to plan for 50% tax rates, just like what you would pay if you went to and lived in Sweden. Except the difference is in Sweden, you get really cool things in exchange for that 50%, like universal health care and paid maternity leave and paid vacation, all these things. Here in the United States, what are you going to get in exchange for that 50% tax? You're going to get to pay for the service on the national debt, and that's about it. I almost exclusively tell young people, invest in Roth accounts. You're probably in a lower tax bracket today. So don't get the deduction at a lower tax bracket. Pay the tax at that lower tax bracket. Get those dollars stocked away. Let it grow and compound over a long period of time. And then take those dollars out tax-free much further down the road when tax rates are likely to be much higher than they are today.
In your book, you said that the U.S. spends 76 cents per every dollar that's taxed on just 4 items: Social Security, Medicare, Medicaid, and then the interest on the debt. And that number is probably even higher than...
Oh, yeah. So it's like 97% now.
Yeah. So 97 cents in every dollar taxed. Something's going to have to change in the future. So David McKnight, since your book is called The Power of Zero, can you explain some of the core concepts on how to reach this 0% tax bracket in retirement?
Yeah. And first of all, why is the 0% tax bracket so critical? Why do I make that such an emphasis? It's because if you're in the 0% tax bracket and tax rates double, 2 times 0 is still 0. By the way, there's no such thing as the 0% tax bracket. The current tax brackets are 10, 12, 22, 24, 32, 35, and 37. So 0% is just really my way of describing a condition in which one is not paying tax. So basically, in my book, I identify, there's millions of different types of investments out there, but when you boil it right down to the main brass tacks of it all, there's only 3 basic types of accounts within which one can save money for retirement. I call them buckets of money. The first bucket is what we call the taxable bucket, meaning every year as your money grows, you get to pay a tax. These are the least efficient of all investments. These are your brokerage accounts, CDs, money market savings accounts. These are great because they're liquid, which means they make for great emergency funds. And most experts say you should have about 6 months worth of basic living expenses inside those emergency funds. You can have too much money in this bucket. I see people all the time. I see the couple who lived through the Depression. They shuffle into my office. They say, Dave, we got 9 CDs for $100,000 each sitting in 9 different banks, and we think we may be paying too much in tax. Well, are they paying too much in tax? Sure, they've got too much money in their taxable bucket. So what we're looking for in that bucket from a tax efficiency perspective is basically 6 months worth of living expenses. The second bucket is where most Americans have the lion's share of their retirement savings accumulated, and that's the 401k IRA. It's what we call the tax-deferred bucket, where you get a deduction on the front end. You postpone the tax till somewhere down the road, and then when you take that money out, you pay ordinary income. What does that mean? Well, basically, if you put money into your 401k, all you really did was postpone the receipt of that money until some point much further down the road. And when you take the money out, at what rate are you taxed? Whatever the tax rate happens to be in the year you take that money out. So like I said, that's like going into a business partnership with the IRS, and every year they get to vote on what percentage of your profits they get to keep. So not a great business partnership to be in. So this made sense. These types of accounts made sense back in the 70s when tax rates were like 70%. So you got a deduction at these high marginal tax rates with the expectation that down the road you would be in a lower tax bracket in retirement. So that made a lot of sense back then. Well, now it's been flipped. That whole paradigm has been flipped on its ear. We're now at historically low tax rates, with experts predicting that tax rates down the road could be as high as 70%. But the problem is Americans haven't updated their paradigm or updated their investment, MO to keep up with these changing paradigms. And so that's part of what I've been trying to do, is get the word out on hey, the paradigm's changed, so you should be changing the manner in which you accumulate money for retirement. And then the third bucket is what we call the tax-free bucket. And I love the tax-free bucket because, number one, if it's a true tax-free investment, you don't pay any of three taxes. You don't pay federal tax, state tax, capital gains tax. And when you take money out of a true tax-free investment, it does not count as provisional income. It does not count against the thresholds which cause Social Security taxation. So if you're living out of your tax-free bucket in retirement, you're dramatically increasing the likelihood not only that you're shielding yourself from the impact of higher taxes, but that you get your Social Security 100% tax-free. So there's all sorts of residual benefits from being in the 0% tax bracket, being in the tax-free bucket. I like to tell people, hey, in a rising tax rate environment, there's an ideal amount of money to have in your taxable and tax-deferred buckets. Anything above and beyond those ideal amounts should be systematically repositioned to tax-free. You want to shift that money slowly enough that you don't rise into a tax bracket that gives you heartburn, but you want to do it quickly enough that you get all the heavy lifting done before tax rates go up for good. And I'm telling people that, according to a lot of experts, tax rates are going to probably have to go up in 2030. So if you're going to get all your money shifted to tax-free, try to get it done before that. Okay, folks, that was part one of my interview with podcast host Jesse Wright. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power of Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head on over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you in the next video.